All right, good afternoon, everybody. Hope everybody's doing great. We're going to get this call started here. I appreciate everybody jumping on. I see a lot of you still jumping on here. So we got a lot of information to go over in a very short period of time. And this is actually one of our favorite topics to be able to do here. This is Roth versus traditional. And this is going to come down to a lot of taxes too. So I know a lot of you jumping on here. We get this question really often. Is what's the difference? How do we make this kind of decision? And so today we're going to give you a lot of information that's going to show you kind of how to make that decision, what the best route to go is for you and your family as we go through. Again, my name is Ryan Polimeni. For those of you who have not been on a MyFed University webinar before, welcome. For those of you who have, obviously you know that we take a very different approach to a lot of the benefits trainings that we do. And what I'm going to share today, again, maybe a little bit different from what you've heard, kind of showing you from a little bit of a different angle. And again, feel free to take notes as we go through. We have another network representative on here as well. His name is Alex. He'll be jumping in if need be. But again, today's one of our favorite topics. And for those of you, once again, who are not familiar with the MyFed University brand, it's a national brand. It's one of the top trainers in the federal space, and we'll talk a little bit more about that as we go. So as we dive into this, I want to give a couple disclaimers. Again, we are network representatives of MyFed University. It's one of the largest federal education companies on the planet. And today we're going to give a lot of general information. So you're going to hear things on taxes, because obviously I don't know how you make a Roth versus traditional, how to choose which one without looking at it from the basis of taxes. You may hear us talk a little about estate planning and how it all kind of pulls in. Just being clear that this is not any advice that you take and go put back. This is general information. So before you make any decisions, talk to somebody. One of the things that we're going to be able to do is give you the ability to you talk to someone from MyFed University, one of our network representatives. So if you have questions, they'll be able to actually take you through the process of figuring out Roth versus traditional. Okay. And we'll talk about that too as we go. So again, MyFed University is a massive nationwide federal education company. It's actually made up of top federal employees. And so a lot of the information that MyFed University gets to build out these topics are really built around what it is that we hear from in the field. So, questions that a lot of federal employees have is how we come up with our content, but a ton of educational webinars, free financial planning tools. And if you have not yet subscribed to the MyFed University website, I highly recommend doing it, because if this is your first webinar, there are so many on the back side of the website that you can actually get access to and get a lot of great content. So you can, again, you'll be able to get that on the back side of MyFed University's website. So one of the things that everybody that attends a MyFed University webinar gets is a income benefit analysis. And what the benefit analysis does is it's a report like this, and I know some of it may be small on your screen, but it's a report that not only tells you what your benefits are going to be, but it does it on the most tax efficient manner as well. So it shows you what your federal benefits would be based on if you're a FERS, SERS, even if you're a contractor employee, you'll be able to look at that as well. It's going to give you a TSP projection, which I love, because a lot of people say, hey, if I keep going this route, and I earn this much, how much is my TSP going to be? And so again, we give you the ability to see that. And then what this does is it shows you, based on your income coming in and expenses going out, if there are any gaps in your income. So, so important. At the very end of this workshop, there's going to be a survey that pops up. Go ahead and fill it out. Let us know if you want this report. It's a great report that a lot of people, we probably do 100,000 of these a year, and it's very beneficial, because you can get one done every single year that comes in. There's no cost to doing it. We give it to every single person that attends these workshops. So a great value add. Again, it's just something that MyFed University has done. MyFed University, for those of you, again, who are just getting to know the brand, it is a government registered entity. The ability to be able to go and bid on government contracts. So, again, we do this for a lot of different agencies, and it's something that you'll be able to get at the very end of this workshop. And I know a lot of you are going to come in with a lot of questions, and you're going to have some more questions, because as I go through this, I'm probably going to generate even more questions for you. Once again, at the very end of the workshop, you're going to have the ability to get those questions answered. So what you're going to want to do is write them down throughout this workshop, and then at the very end, when that survey pops up, I want you to go ahead and fill it out, but be as detailed as possible, because every single person's situation is going to be different. So be as detailed as you possibly can with the questions you have, and someone from the MyFit University team will get back with you. We'll answer every single one of your questions. Okay. Now, once again, we're going to talk a lot about taxes. So I want to start with the 2024 tax brackets, because remember, whenever you're thinking Roth versus traditional, what it truly comes down to is how it affects you in the tax wise. There are situations where it does not make sense to go to the Roth. It does, sometimes it does not make sense to be all in traditional, and you should go on all Roth. But in order to make those decisions, we have to start with building it on the foundation of taxes first. So what does that mean? Let's take a look at this chart. These are the 2024 tax brackets. Now, I know we're at the end of the year, and in 2025, these brackets are going to slightly change. But before I dive into this, here's one thing that I want everybody to write down. And, again, this is so important to you to know. So write this date down. And I wish I had this live, because I'd ask the question. Probably very few people understand what's going to happen. So January 1st of 2026. So it's a very important date, and I would write that down. So if you're taking notes, January 1st of 2026, so important. I'll tell you why that date is so important. Built into the tax laws that we have from the 2017 tax cuts was this thing called a sunset provision. And what that means is, if Congress does not make any changes to the tax brackets between now and then, which, look, we got an election coming up, who knows what's going to happen, slim chance they're going to do a tax reform between now and then. If nothing changes, we're going to revert back to the 2016 tax tables on January 1st of 2026. So what does that mean? That means that these brackets that you see are the largest they've ever been. And I know a lot of you don't feel like it, right? But taxes are actually on sale. We've never had taxes so cheap. And I know, again, we pay a lot in taxes. Sometimes it doesn't feel that way. But think about this for a second. We have a 10, 12, 22, 24, all the way to 37. January 1st of 26, every single one of those brackets is minimally going to go up 3%. The other thing that's going to happen is the space between each bracket. So for example, if you look in the middle of your screen, right, you've got the 22% tax bracket, goes from 94,000 all the way to 201,000. If you're married, filing jointly, that's a huge gap. That's going to shrink. So once again, you need to pay attention to this stuff, because it's going to affect a lot of people if you're not prepared for it. So one thing is, again, if that's something of a concern, write that down in your notes and put on the survey. We'll make sure we address it as we go. So, but let's take a look at these brackets for a second. So you've got the 10, 12, 22, 24, 32. Now I'm going to kind of stop there, because most people that are going to fall in that 22 to 24% tax bracket. That's an average bracket we see a lot of. Now, if you're single, you look over to the left and you got the single taxable income, and you can see, for example, the 22% goes from the $47,000 to $100,000 in income, right? That's a pretty big income gap there. Now, again, things like a standard deduction coming off, that's going to play a role in really what you pay tax on. But I want to focus on this for a second, because I'm going to give you an example shortly of how to make a Roth versus traditional decision, but by doing it basis on how this tax bracket works, so that you truly make the right kind of decision. Because I'm going to, I've had the privilege now of teaching these workshops for over 15 years. And again, we run a tax firm. And so I'm going to kind of give it to you from the tax perspective. Some of the largest mistakes we see made, especially from running a tax firm, is how many people don't take this into consideration. And what they do is they hear this Roth thing and they think it's so great, they do it, and then they end up having this massive tax bill because they bump themselves to a higher tax bracket. And that's what I want to help everybody avoid today as we go. Okay, so let's start by figuring out what is taxable, because Roth and traditional are going to play such a great role when it comes time to retirement, and it all depends on how you have it structured. But to truly understand how you're going to be taxed and what the right thing to do is today, we need to first figure out what is taxable in the future. So if every single one of you on here is a federal employee, which I believe everybody is, we have almost 700 people on here that are believe are federal employees, you're going to have a pension. It's going to be either CSRS or it's going to be FERS, right? One of those two. Now, let's be clear. Does not matter which one it is, they are both going to be taxable. So that pension, or you're referred to as an annuitant. When you retire, you're not going to hear the word pension, you're going to hear the word annuity. You're referred to as an annuitant because you're going to get an income for life, which is what an annuity is. So, but that annuity or / pension is going to be taxable at an ordinary income tax bracket. So what we just looked at, those tax brackets, you're going to fall somewhere in there, and your pension is going to be taxable at that bracket. Now, that middle bucket is your IRA TSP distributions, right? This is kind of a wild card bucket because this bucket really truly depends on what it is that you have. If you have Roth, well, that's going to be a tax-free bucket. If you have traditional, which most of you have, that is going to also be fully taxable at your ordinary income tax bracket. So you have a pension, and you have this potential taxable income from your TSP distribution, right? And you got to take those things into consideration. And I'm going to tell you why those are important, because most people have a preconceived notion that when they get out of the federal system and they retire, that they're going to be in a lower tax bracket than when they were working. So again, 15 years now working with federal employees all over the country, I can tell you that 63% of our clients are in the same tax bracket as when they retire. And you go, Ryan, how could that be? And I'm going to give you a couple of reasons why, but because federal employees truly have this 3-bucket system. They have, you have pension, which only 16% of Americans have, right? You have the TSP, and if you are not a CSRS member, you have Social Security. Social Security is also kind of that wild card, because if I were to ask, all 700, 800, how many people are on here, if you know how Social Security is taxable, most people will say, no, I don't understand it. So, but Social Security is taxable based on those other 2 buckets. And I'm going to share with you how it's taxable shortly, but this is why Roth versus traditional is such an important decision, because it affects so many other things in your retirement that a lot of people don't take into consideration. So what I want you to think about today is how all the pieces start coming together. We could isolate this. I can tell you in 10 minutes Roth versus traditional, but what is important is that you truly understand how everything works together in harmony, because if they don't is where mistakes are made, okay? Now, here's a 3-bucket strategy. So I want you to think about that. I'm kind of giving away what our firm does. We're a wealth management firm as well as a tax firm, as a network representative of MyFed University. And when we work with people, whether it's federal or private sector, we work on this thing called a 3-bucket strategy. And I would write this down because I'm kind of giving away more than we normally do here, but I think it's so important when it comes to the topic that we're talking about. So bucket number 1 is, to me and to our firm, is the most important bucket, and that's the bucket of income. And again, this is so important when you're making a Roth versus traditional decision, because if you have Roth money, that's going to be tax-free money, and that's going to affect your income bucket in a positive way and really help you save a lot of money in taxes, okay? So bucket number 1 is truly knowing your income sources. This is why I said at the very beginning, we do that income report, that benefit report for everybody that attends these, because I don't know how you make decisions without knowing what your income is going to be, right? Knowing to the penny what your pension is going to be is so important, because when we know your income bucket is secure, then everything else becomes easier. But you need to know, okay, my income bucket is my pension or my annuity. It's going to be my Social Security. So those are 2 fixed incomes. and then my distributions from my TSP, and when am I going to have to take those, and how am I going to take them, and in what order am I going to take them, right? It's just another question we get so often. And then once that income bucket is really secure and you know how to identify what's going to go in there, then everything else becomes kind of a different strategy from there. But let me give you something that I think is important. When you're thinking about TSP, whether it's a distribution from your Roth or your traditional, I want you to think about it a little bit differently than you normally have. Here's an example of what I mean. Most of you think about a diversified portfolio, right? You think about like the L funds, for example. You got all diversification. However, when you're thinking about distribution, especially coming from Roth, especially coming from traditional, what becomes more important now is how you start earmarking dollars to perform certain things. Meaning it stops becoming about this balanced portfolio and it becomes more of, I've got $500,000 saved in my TSP. How much of that $500,000 am I going to have to earmark for the purpose of filling my income bucket? How much am I going to have to earmark to save that I don't want to lose? How much am I comfortable earmarking for long-term growth, right? That's how this 3-bucket strategy really comes into play. The middle bucket we're going to focus a lot on today, which is sometimes doing things like Roth conversions. And I'm going to hit on that. So for those of you that are kind of maybe at the tail end of your working history and maybe you didn't do a whole lot of Roth, but you're thinking, man, what a great opportunity for me to be able to get some Roth going on. You could do a thing called Roth conversion. I'm going to talk a lot about that as we go. All right, now, well, I told you that I was going to share with you quickly how Social Security is taxed. And some of you going, why are we talking about Social Security when it's Roth versus traditional? Because remember, the way you take a distribution from Roth or traditional is going to have the greatest effect on how your Social Security is taxed. And if you don't know how this comes together, this is where your mistakes are going to be made. Here's an example of what I mean. We had a client that came through one of our last workshops, and she did not know how Social Security was going to be taxed. She took a distribution from her TSP, more than what she needed to, and it affected her Social Security so much that it bumped her into a situation where 85% of her Social Security was a taxable income. She did not withhold taxes and got a $6,200 tax bill the next year. Now, I don't think any one of you listening in, I don't care how old you are listening, I don't think any one of you want that type of problem or tax bill, and that's what we're trying to help you avoid here. So let's quickly talk about how Social Security is taxed so you understand how these pieces come together. So if you're single and you make less than $25,000, there's no tax on your Social Security. If you make between $25,000 and $34,000 after the Social Security provisional income formula, which measures this, then up to 50% of your Social Security would be a taxable income. If you make more than 34,000 and you're single, you file single, up to 85% of your Social Security could be taxable. So what does that mean? If you're making $1,000 a month in Social Security and you go above this 34,000, let's say because you took a big distribution from your TSP traditional and it bumped you over this and you didn't realize it. If you're making $1,000 a month in Social Security, about $10,500 of that is going to go on your tax return as a taxable income the following year. And if you don't withhold ordinary income tax on that money, guess what's going to happen? You're going to get a big tax bill. So these are things to pay attention to. Now, again, if you're married filing jointly, this is both of your incomes together. And we get a lot of questions on Social Security, and we teach a lot on Social Security. So if at the end of this, you have a lot of questions around Social Security, please feel free to go ahead and write that down, and we'll address it. Now, if you're married filing jointly, less than $32,000, no tax on your Social Security. Between $32,000 and $44,000 combined income, up to 50% of both of your Social Securities could be a taxable income. Now, if the two incomes combined are above $44,000, then 85% of both you and your spouse's Social Security will be a taxable income. So again, this Roth versus traditional decision is so important because of how many things it affects. All right, so let's talk about the advantages of TSP, and then we're going to talk about the differences between the two. So it is, you have the ability to save, if you're over the age of 50, including the catch-up, 30,500. So you get 23,000 regular. So if you're under the age of 50, no problem. Or if you're over the age of 50, the regular contribution limit is $23,000. Now, if you're over the age of 50, the catch-up contribution is 7,500. So that means that this year you can contribute 30,500 into your TSP. Now, I want to be clear. It is 30,500 total contribution. So it's not 30,500 into the Roth. It's not 30,500 into the traditional. It is a combination of everything. So it's 30,500 no matter if you have a little bit in Roth, a little bit in traditional. It's a combination of the two. That's a very common question that we get. Now, again, nice thing about TSP is you get matching contributions up to 5%, so that's obviously helpful. So these are just a few of the advantages of TSP, and a lot of people are not taking advantage of it, and so we highly recommend that you do. Again, if you need a little bit of help with TSP, maybe understanding some of the ins and outs of it better, that's what the team at MyFit University can do to help answer those questions. So let's talk about traditional for a second. Traditional TSP is what the majority of you are contributing to. Now, if you did not choose to go into Roth, you were automatically put in the traditional TSP. So those are pre-tax contributions. So what happens is you get your paycheck every 26 pay periods, and before you're taxed, money gets moved over to the TSP. And what you're doing is you are deferring. That's why it's called that grows tax deferred. You are deferring your income, your distributions from the TSP to a later time. Again, with the notion, hey, no big deal because I'm going to be in a lower tax bracket. Again, not always true. Now, all matching contributions at this point go into the traditional TSP. Even if you are, and here's a question I get all the time is, if I do the Roth, do I still get the matching contribution? And the answer is yes. However, all the matching contributions will always go into this traditional TSP at the moment. That is subject to change, hopefully someday, but right now, that's where the matching contributions go into. But what's the advantage of using traditional? Well, any dollar you put into the traditional TSP is actually helping you lower your tax liabilities today. Here's an example. If you make $100,000 and you put $10,000 into the traditional TSP, what's going to happen is you're actually going to pay tax on $90,000 because you use those pre-tax contributions to lower your tax liability. So there are some advantages, and this is what I was talking about. You have to understand when you make these type of decisions to Roth or traditional, is it going to affect you today, and how much will it help you long term? That's why we want to make sure you understand the differences here. So again, a great tool while you're working, because I see a lot of people that actually need this. I've had the privilege of working with a lot of high net worth federal employees who have, who are in the millions in their TSP. We do a lot of management with them, and having a lot of money in traditional definitely help, but now in the future is where things get a little more complicated. You spend a lot more time kind of undoing the traditional to go to Roth. I'll talk about that shortly as we go. So the next part, and this is the complete opposite, this is Roth TSP. Roth TSP, we call it golden nugget number one because there are 3 golden nuggets in the federal system, and what we see, the people who have the most success going into retirement have taken advantage of all 3 of the golden nuggets. I'm going to give you one of them today, and it is Roth TSP. Now, this is like the complete opposite of what we were just talking about. This is where you get your paycheck, you pay all the taxes, and then the money gets moved into your TSP. Now that's a Roth TSP. So the nice thing about that is all the money you put into there, so all your contributions, all of the gains and interest and growth that takes place. So if you put in 50 grand and it grows to 100,000, every single penny that's in a Roth TSP is 100% tax-free when you take a distribution. Now you have to be in there for 5 years. So disclaimer, you must be in the Roth for 5 years to reap those tax benefits, or you will create a taxable income for yourself if you don't. So for those of you going, man, sounds like a great opportunity. I'm going to retire in 2 years. Let me just do it for the next 2. Be very careful. It has to be in there for 5 years. Now you can, once again, if you're over the age of 50, you can put in $30,500 into this account. Why is that important? Because if you were to go to XYZ Financial Corporation down the road and you say, hey, I'd like to open up a Roth IRA, they're going to say, great. How much would you like to put in? You say, well, my 401k or my TSP allows me to put in $30,500. I like to do that. They're going to say, sorry, even though you're over the age of 50, your maximum limit is $8,000. So you have a massive advantage. And I'm going to tell you right now, very few people take advantage of their Roth TSP. I see a lot of people that come to us that get a report done and they have questions and they have Roth on the outside, but they're not fully taking advantage of it on the inside, where you can truly put in a lot more than what you can on the outside. So very important. Now, remember what I just said too. Every single distribution that comes out of the Roth TSP is 100% tax-free as long as you met that 5-year mark. So let me go back for a second. We looked at the tax brackets. We talked about Social Security. We talked about the different buckets of income. Think about the importance of what I just said about the Roth being tax-free now. Because remember what we looked at, your Social Security alone is the way that Social Security is taxed is based on your total taxable income sources. Right? So if you could eliminate your TSP distributions, think about what that would do to help lower your tax liabilities on everything, right? Because let's say you took a $30,000 yearly distribution from your TSP, and you have the $30,000 distribution, you have your annuity from the government, and you have Social Security. Now you have 3 taxable incomes. And your TSP distribution could be the thing that bumps you from like maybe a 12 to a 22% tax bracket, and there's nothing you can do about it because you need the income. But if that was the opposite and that distribution was Roth, that's 100% tax-free. So now you can stay in a lower tax bracket. See, these things and these decisions are so important. But again, I want to give you a word of caution because some of you going, man, I'm all in on this thing. And I don't blame you, but you have to remember about what are some of the implications today by going all in on the Roth. And so we're going to kind of walk through a scenario. So let me take you back down to the brackets, right? This is where we started with. So again, look at these different brackets. A lot of you are going to fall in that 22% tax bracket. And with what I just went over, whether you make the decision today to go into the Roth, think about how that's going to affect your tax bracket today while you're working. You may be in that middle, married filing jointly, and your income may be right at about 105,000, right? But your $10,000 contributions to the traditional is keeping you in the 12. If you stop, you're going to go right back. And I'm going to give you an example of how the numbers break down here. So let's look at this example. So if you came to us and you said, Ryan, I want your team to help. I want the MyFit University team to help me really make this decision because these are numbers, and a lot of people get lost in the numbers. The first thing we're going to do is we're going to start from the top down. So here's an example of a federal employee that is going to be able to take advantage of both, which is a great situation to be in. So this is a single employee. Now it could just be a single filer. She is making $65,000 a year. So you can see that because of $65,000, that falls in a 22% tax bracket for federal. Now I'm not talking state, I'm talking just federal today, okay? Because that tax bracket is $47,000 to $100,000. So $65,000 is kind of smack dab in the middle, right? Then we have this gift from the IRS called a standard deduction. And the standard deduction for a single filer this year is $14,600. Now, to be clear, That number changes every year, so you got to know, because when we ran this same exact scenario last year, it was totally different. Okay, so you need to understand that these brackets and the deductions change year to year, so you want to have this looked at on a year-by-year basis. So after standard deduction from their $65,000, their taxable income is $50,400. So still, you can see, even after standard deduction, they are still in the 22% tax bracket because they have to get below 47,000. But this individual contributes $10,000 to their traditional TSP. Now, remember what I told you. Traditional contributions help lower your tax liabilities while you are working. So in this example, their total taxable income for the year, because they use the traditional TSP, brought them down to 40,400. Which, what did that do? That also brought them down from a 22 to a 12% federal tax bracket. That TSP contribution into the traditional saved them 10% in federal taxes by making that decision. And so a lot of you are going to be teetering on the edge of those brackets, which is why it's so important to get your numbers run so you know how to not make mistakes. We see it all the time, because look at this actual situation that this person's in, right? The 10,000 brought them down to 40,400 in taxable income. But if you look at the 12% tax bracket, it goes from 11,000 to 47. So what could this federal employee actually do? Well, they could use about 7,000. I would probably push it. I'd probably say, you can do a split. You could do 5,000 into the traditional TSP, 5,000 into the Roth, and that could help keep you in a 12% tax bracket, but you're getting the best of both worlds. See, that's how you begin to make these type of decisions on, should I go Roth, should I go traditional, by looking at the numbers and working them backwards. And again, if you decide to get the benefit analysis, this is exactly what you're going to get included in that. So when you meet with somebody from the MyFed team, they're going to run that, and this is what they're also going to tell you is, should you go Roth, should you go traditional? It is a question we get 1,000 and thousands of times a year, and this is how we figure those things out. Okay, so very important to work the numbers backwards. Now, I want to talk about TSP, or excuse me, Roth conversions. So for a lot of you, you may not have the opportunity, because maybe you're in a situation where you need every single penny to be going into the traditional TSP to keep your tax liabilities lower. Maybe that you're not in a situation where you can put any money into the Roth, because that $10,000 you're putting in is truly keeping you from a 22 to a 12, and there's just nothing you can do. Like, Roth just doesn't work. Or maybe you're now in a situation where, hey, I'm getting ready to retire in a few years. I don't have the 5 years to wait. Got it. Roth conversions, I got to tell you. So again, being a tax firm, we're doing more Roth conversions than I ever thought humanly possible. And again, why? Because it goes back to the incredible opportunity we have right now from the tax brackets that we have and the advantages that are given to us. A Roth conversion is when you take your traditional TSP and you convert it to a Roth. I did not say Roth TSP, I said converting it to a Roth IRA. Here's what happens. Understand this. Roth conversions are important, but they cannot be done internally. Okay, you cannot say, man, this Roth thing sounds really good. Let me just take what I have in my traditional and just move it into the Roth. That will not work, because they don't allow you to do that, number one. And if you did that, number two, you have just created a massive, massive tax problem for yourself. So avoid that like the plague. If you're going to do a Roth conversion, typically they need to be done over a 5 to 10 year period of time. This does require a deep level of tax planning, because this is really truly where you need to get in, know your numbers, know how much space you have, run a mock tax return. There's a lot that goes into this. But why is this important? Because think about this for a second. Roth, again, Roth IRAs, Roth TSPs are tax-free when you take them out for distributions. So if you didn't get the opportunity to take advantage of the Roth TSP, you can now do a conversion to a Roth IRA and get the same tax benefits by doing that conversion, okay? So really important. Now, here's a couple other reasons why Roth is important. When you pass away and you have any money left in your traditional TSP or traditional IRA, be very clear, your family is on the hook for the taxes that are liable for that. Okay, so your family inherits the tax problem. When you die and you have money in a Roth, that money gets moved to your family tax-free as if it would come to you. So from an estate and legacy planning perspective, this may be part of your money where you say, you know what, I've got more money in my TSP that I'll never need. I want to make sure my kids get half of my TSP, but I don't want them to inherit this massive tax problem, because maybe you're going to leave them half, I'll make it up, maybe leave them $500,000, and they're going to have $100,000 tax, bill when they take that out. Well, you could avoid that by, maybe this is that part where I was going kind of back to that bucket strategy, right? This is where you start earmarking, well, what part of my portfolio do I want to leave to my family? Maybe that's the money you earmark, and that's the money you do Roth conversions with. So there's so many benefits to Roth. And here's the other really important thing to know here, because some of you are going, I have, $300,000 in my traditional, and I thought you could only put $8,000 a year into a Roth. How's that going to work? That is a Roth contribution. A Roth conversion is totally different. There is today, now this is today, right? We're in 2024. There is no limit on how much you can convert to a Roth IRA. There's no income limit. So some of you are going, I make too much money, I can't contribute to a Roth IRA. That is true. However, a conversion does not have an income limit, nor does it have an amount that you can convert limit. We have clients that have converted 6 figures. We have clients that are converting 20 grand a year. It all depends on how much you can convert and still stay in the same tax bracket, or maybe sometimes you have to go up a little bit. But very, very important. This, for most of you, I got to be honest with you, I would write this down at the very end when that survey pops up, I would write this down in the notes tab and be as specific as possible so we know how to answer your questions. And for a lot of you, Roth conversions is probably the #1 conversation we're going to have after this workshop. Every time we do this workshop, we have hundreds and hundreds of federal employees that request for us to go through and make sure and see if this is something that works for them. So feel free to make sure you put down as much information as possible. Okay. Now, I want to show you this. This is so if you decided, how do I figure this thing out? How much am I going to be able to save? Should I do a Roth conversion? This is an example of a client. This is on a very small scale, by the way, but this is the example of a client that decided to do Roth conversions. And you can see over here on the right, some of the differences. Like you can see all these pie charts different, right? And all the way to the right, that there's a blue and a green chart. And it says withdrawals from tax deferred accounts. Well, if you look to the all the way to the right where it says proposed tax results, the first thing, just look in the middle. By doing Roth conversions, this client was able to save $37,157 in taxes. Now, I want you just to think, and they were forced to withdraw $968,000 less from their tax deferred because this thing called the required minimum distribution. Okay, so this is a small example, to be honest with you. We had somebody that came through one of these workshops. a federal employee, did a great job saving. They had $1 million in their TSP, did a phenomenal job saving. And when we decided to go down the road of Roth conversions, because it made a lot of sense, because it was going to keep them from going to the next tax bracket and being forced there forever. When we did the Roth conversion, they figured out that from age 65, when they started the conversions, to age 90, if they lived that long, by doing the conversions, saved them $484,000 in taxes over that period of time. Now, I don't know about you, but I would not be upset about saving that much money in taxes by utilizing a strategy that a lot of people utilize. So once again, very important to consider this, because this is one of those really big pieces to your financial puzzle that's got to be done the right way, but it's got to be done strategically. And I got to tell you, we work with a lot of federal employees that have never even heard of this before. And whether you're going to do this by yourself or you're working with an advisor, if they have not talked about or you have not considered Roth conversions and the tax implications this could save your family, it should be a red flag. It's something that everybody should be considering. Now, whether it makes sense or not to do it, that's totally different. But this needs to be a consideration, because for most people, it's going to be a huge opportunity to save a lot of money in taxes while you're alive and passing it on to your family. Okay. Now, passing assets, we talked about this for a second. I'm going to put my estate planning hat on here for a second, because my goodness, we do so much estate planning, and a lot of people don't understand the changes that took place. So this is why Roth versus traditional is very important to understand, because once again, anybody that is not a spouse, so your kids, your brother, family, anybody that's not a spouse, has 10 years now to spend down any IRAs that they inherit. Okay, so what does that mean? That means that if your son or daughter, or your combination, if you have multiple kids, if let's say you die and there's $500,000 in a traditional TSP IRA, they have 10 years to spend down that $500,000 and pay the taxes on there. Now, if your kids are in their prime working history, let's say they're 30 or 40 years old, they're making six figures, and now all of a sudden they inherit, they have to take $50,000 a year out, and that bumps them into the next tax bracket. Think about what that could do, to them every single year for the next 10 years. I mean, that's a lot of money to have to go through and pull down and really mess them up. So Roth, by considering things like Roth conversions, allows you to be able to pass that money on to your family tax-free. You're not burdening anybody with the tax. Now, some of you going, I don't really care. They're going to inherit a bunch of money to deal with it, right? I get it. But think about the implications that could have. So once again, you look at earmarking dollars instead of this balanced portfolio thing. You look at, how does my money going to work for me in retirement? What's going to go where? And this is how you begin to make those decisions. Should I convert? Maybe I only need to convert, I have $500,000. Maybe I'm only going to convert 200,000 into a Roth, and I'm going to use the other 300,000 for income. Perfect. You got a plan there, right? It's a strategy, something to work off of. But the point that I'm trying to make, and this is a big mistake I see a lot of people, is don't go into retirement blind, right? Don't go into it kind of throwing darts on the dartboard hoping it works. Go into it with a real strategic strategy that you can use and implement, from day one, okay? Now, this is so important. I want every single person to write this down. Required minimum distribution. This right here, folks, and I'm going to give you some extreme examples. This is the number one silent killer of people's retirements, because this is the one thing that forces people to a higher income tax bracket than they need to be in. So I know, we're in the federal system, we like acronyms, right? RMD, required minimum distribution. What happens here is, if you haven't reached the age of 70 yet, or 70 and a half, at 73 or 75, the IRS is going to knock on your door. They're going to add up every single traditional TSP, IRA, maybe you have an old 401k. They're going to add all of those accounts up, and they are going to tell you how much you need to take out of those accounts every year. So I want you to think about this for a second. What if you needed $10,000 a year? Remember we talked about our 3-bucket strategy, right? In that first bucket, you figured out I only need $10,000 a year more from my TSP on top of my pension, on top of my Social Security to really fill my income bucket to feel great. Perfect. And let's say you've done a phenomenal job saving and you have $1 million in your TSP. Guess what's going to happen? They're going to knock on your door and they're going to say, hey, you've done a great job saving. You have $1 million in your traditional accounts. You need to start taking out $40,000 a year. And you're going to, no, I don't need 40,000. I'm good with my 10 because it helps me pay my bills and life is good. The IRS is going to say, I know, but you have to take out 40,000 because that's our required minimum distribution. You had the opportunity to defer. Remember, we talked about the word defer. You deferred for 73 years of your life or 75 years of your life. It's time for us to start getting our tax dollars, and they're going to force you to take that out. I want you to just stop for a second and think about this example. What if you were in that situation? And I know this is extreme because I gave you $1 million, but what if you were taking out 10,000 and now all of a sudden you were forced to take out $30,000 a year more than you need to? What do you think it could happen to your tax bracket? Right? It's going to go up. And this, folks, right here is why we do more Roth conversions than anything else in our firm. I got to tell you, on the tax side, because if you can convert money from a traditional to a Roth, Roth IRAs, Roth TSPs are not included in the required minimum distribution calculation. So if you can convert your money ahead of time, or you can take advantage of Roth while you're working, right? You have the opportunity to lower these RMD problems you could run into. So a very important thing, I got to tell you, we do more tax planning around this than anything else, and this is one of the biggest silent killers that I've seen. Okay, so how does it affect my taxes? Once again, think about if maybe you're in a situation where your Social Security is not taxable, but all of a sudden now you're forced to take out $10, $20, $30,000 more than you need to, and that is what bumps your Social Security up to 85% taxable. Again, you need to look at everything and how it works in harmony. I can't just pick apart one thing because, one decision on Roth versus traditional has such a massive effect on everything else. It could, the RMDs could put you in a higher tax bracket, make your Social Security become taxable, and on and on. And that's it. Again, if you don't take the RMD, or maybe you missed the opportunity to do it because you didn't know you had to, you could have up to a 25% tax penalty on top of it. So again, really important things to understand, really important things to consider. And that's why at the very end, when the survey pops up, be as detailed as possible. If you think that the RMD is going to have a big effect on you, put it down so we know how to help kind of guide you through that, because we do that the most out of anything here. Here's a live example. This is an example that you see of somebody who has $500,000 in their TSP, okay? They're forced to take out $19,607 and change. Now, what if you only needed 10? What if you only needed 5? And you're forced to, we call it being proactive versus reactive at our firm. We would rather be proactive, be able to know the numbers, know how much has to be converted, make those decisions, do it the right way, right ahead of time, instead of reacting when you're 73 years old and the IRS is forcing you to take out something. That's a lot of work to go back. But if you're in your early 60s and you're getting ready to retire, Roth conversions could be your best friend. If you're still working, your Roth TSP could be your best friend because it helps you avoid a lot of these problems later on. I told you before, I have the opportunity of working with a lot of high net worth federal employees, people who have 600,000 to 3 million, in assets. And this right here is their number one problem. And again, if you're doing this by yourself, you need to understand this. If you're working with an advisor and they've never even mentioned the RMD, that's a huge problem, because this is a big tax problem that you're going to run into potentially down the line. Okay. So let's put it all together. We talked about how these things have to work in harmony. Now, again, most people only focus on one thing. I wanted it to be a little bit different today. I wanted you to see all these moving pieces so you understand that, yes, Roth versus traditional is so important, but why is it more important than ever? Because it has a massive effect on everything else. Your pension, or your annuity that you're going to get from the government, right? How your income is affected, how your distributions affect your Social Security, so on and so forth. When you pass away, leaving a legacy to your family, all these things play into that decision, those roles. So here's what you do. Put it all together. Be strategic. Have a game plan. Look, what changes can you make today? I want you to think about this. We just went over quite a bit, and I know a lot of it is still very confusing, and I understand it. It's why we're here to help and answer questions. But if you heard something, take advantage of doing things the next 48 hours. After 48 hours, you're never going to do it, right? So if you heard something that you can make a change to, do it immediately. Break down your real numbers. Understand what things you could do, like, hey, how do I reduce debt? Because the question I get all the time is how do I save for retirement and pay off debt at the same time? And sometimes you can't, but sometimes you can use Roth to pay down some debt because it's tax-free. Again, there's a lot of different things you can do here. And lastly, get help if you need it, because I think it's so important that every one of you do that. Now, one of the things that's going to happen is when you fill out the form at the very end here, it's going to come up in a few minutes, and you request a benefit analysis. Part of the benefit analysis is also going to be this required minimum distribution calculation. It's going to be embedded into your report, so you know what to expect based on how much you have in TSP, how much that benefit analysis shows it's going to grow to. We then take that number, put it into our RMD calculator, and it's going to tell you how much you're going to be forced to take out. And that's really important, because as you put your numbers together, you know how to be proactive versus reactive, right? And that's so important as we put this all together. And lastly, the Social Security report that's built in there. So again, we look at Social Security, your annuity projections, and your TSP distributions are all in Roth. We put it all together into a report that encompasses all these. Now, again, here's what I ask of you, because a lot of you have a lot of questions right now. I do understand that. Like I said before, be as specific as you possibly can. We don't care if you write a book in the comments section, because there's going to be a spot there that's a comment. The more we know when someone from our team calls you, the better it is for us, so we know how to help you and answer your questions. Okay, again, there's no cost to getting your questions answered. There's no cost to filling out the form. Someone from the MyFed University team, which again, is a government registered entity, will call and help out and answer every one of your questions. Okay, so here's a couple of resources. You can email in some other questions additional if you think of some later to the info@myfeduniversity.com, or you can call the number on your screen, 919-706-1846. So just a couple of resources for you there. And lastly, you're going to get this form that's going to pop up here in just a second. Like I said, be as detailed as possible. Let us know what questions you have. If you want a benefit analysis, go ahead and check that off. With that, I sit down and say thank you so much, and we'll talk to you soon. Take care.